Federal Reserve on Wednesday approved a fourth consecutive three-quarter point interest rate increase and signaled a potential change in how it will approach monetary policy to bring down inflation. The bank raised its short-term borrowing rate by 0.75 percentage points to a target range of 3.75 to 4%. That's the highest level since January 2008. The move continued the most aggressive pace of monetary policy tightening since the early 1980s, the last time inflation ran this high. For now, Asian markets are all painted red, with Hong Kong leading losses and the dollar strengthening.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done.
For more on this now, let's go to Han Tan, Exinity Group Chief Market Analyst in Abu Dhabi. Han, many thanks for being with us this morning. So we will stay the course, Powell said, but in somewhat of a well-telegraphed move. That's what analysts have said. Yesterday, the Fed has also signaled there will be a change in policy. What sort of change do you expect?
Indeed, I think the change is primarily around the focus of the Fed's policy outlook. So in other words, instead of paying closer attention to the size or the quantum of the rate hikes, as we've been doing really over the past couple of quarters, it's now about where U.S. interest rates will eventually end up. So markets, have heeded that message and ramped up the expected peak to about 5.1% as we speak. But I think ultimately, as the Fed said, they still have a lot of ground to cover, and it all depends on whether the U.S. inflation data is showing that these rate hikes are having the intended effect of subduing these inflationary pressures.
And a question on Europe. What about rate hikes in Europe? Do you think the continent can stand hikes in rates given the fragility of the economy, especially going into the winter?
I think the Eurozone economy has a lesser ability to withstand those incoming rate hikes relative to, say, the U.S. economy, right? And I think those concerns were evident in the cracks that were showing in the ECB's meeting last week. So although they hiked by another 75 basis points, that decision was not unanimous, right? And even ECB President Lagarde also cited the significant slowdown and the higher recession risks for the economy. So I think those concerns will only be exacerbated, over the months ahead, especially if the energy risks do ramp up, and which also then amps up the inflationary pressures.
Han Tan, many thanks for your analysis today.
Thanks for having me.